And we are live. Welcome, everybody, to the Alternative Investing Club. We're going to wait here about 5 minutes so that all the live attendees can start joining us before we kick this off. But we're looking forward to another week where we hear from an operator who is investing today in this market and creating passive income for themselves and for their investors. So hold on as we let people come in, or if you're watching this in a recorded video, go ahead and skip about 5 minutes ahead and we'll meet you there. We're just gonna have banter, for the next 5 minutes. I plan on, mentioning my weight loss goals because I got to brag about them because I'm tracking them to the 10th of the pound every day.
Yeah, you've done well from what you said, what you told me.
Yeah,
this week. That's fantastic.
What was my weigh-in today? Hello, everybody. Welcome. We are just talking for the next 5 minutes as we're getting ready, and then I'll start off. Yeah, I'm at, I thought I hit 25. I'm at 24.3 pounds over 77 days.
It's darn good.
Very good.
Well, what's really admirable is we're sitting in March, and usually what happens is something that looks like January 3rd, people go get a gym membership, and then something that looks like January 16th, they've gone twice and they're thinking about canceling. So,
I didn't even wait for January 1st. I got the digital scale as a Christmas present, and I said I'm going to do this every day. And so I actually started December 26th.
So who was the motivating force in your life that decided you needed a scale on Christmas?
I actually asked for it. Yeah.
Oh, you did? Okay. Because I think
it wasn't my wife who gave me a scale.
I was gonna say,
although technically my parents gave me the scale, but I asked for it.
There you go. Now it's interesting. If my wife gave me a scale, it would probably be okay. If I gave my wife a scale, I'd probably be divorced.
Yeah. We usually ask. My wife actually really likes gifts that I know are stereotypical for, oh, don't get your wife that, don't get her a blender. She's like, I wanted an immersion blender. Okay.
And that's why you're a pragmatic guy. You invest in real estate. You make sensible choices.
My wife is too.
Yeah, there you go.
Hello, everybody. I see that we are starting to get some people in here. So welcome to the group. We have comments coming in.
Weight loss comments?
Yeah, okay. No comments about the time zone issue. So yeah, the time zone changed, and I tend to post all the times in Universal Coordinated Time, which is Greenwich England time. And so there was a time zone issue this week, and I'm hoping it'll go away next week because I auto post through StreamYard, and yeah, it should be gone next week.
Cool.
All right, Mr. AI says, Daniel, please give us an update. If you started to receive payments from the two oil investments yet, I'm waiting for the third to start. All right, so yeah, let's talk about that. Last year we had two oil investments, one in Wyoming, one in Colorado. The K1s are supposed to be going out in mid-March here for both of them. Payments have not started on them yet, although with one of them, there was a partial payment that came in for, I think, the last 2 days of the month. And so it's just being held until there's a full 30 days, and then the payment's going to go out. The other one should be following very closely behind. I expect it this month or next month. So I actually did request an update on both of those from our sponsor. K1s are posted in the portal. Okay, great. There you go. All right, Bob. Yep, there's a problem with the time and date. Is it that way on the Alternative Investing Club page? If I share my screen here, do we have a problem here? Share screen. Let's see. We're going to go to Friday Live, register. Okay. Well, no times mentioned here. By the way, I only have two meetings posted here, but we have a slew of really good investments coming up. I am and I hate to say this in front of our current people who are club fund members, but we have several good investments that are coming up, and they're all completely different business strategies, and none of them are multifamily. So I'm really looking forward to. We're going to be hearing again from Capital, and he struck out on his own, and Ben Lapidus, who is the founder of the Best Ever Conference, one of the people that ran it for quite a while. We have a senior living facility coming up. Really good stuff coming up here. So I'm excited for this year. We're going to be taking the fund and diversifying it quite a bit. And oh yeah, so the active loss on our oil deal was 84%. So for every dollar you put in, you got a 84 cents of tax deduction on taken off your active income. So your wages, your Intel income or your job income. All right, let's kick it off here. I see this time issue may have caused our numbers to be a little lower than normal, but we're going to kick it off anyways. Post in the chat where you're from. Hello, Perlette. It's always good to see you here. Oh, it didn't let you in because the time was set differently? Oh, that's a problem. All right. I'm going to kick it off to our speakers really quickly here, and I'm going to go see if I can fix those issues. Okay. Feel free to put where you're from in the chat. I always love to see where people are coming from. Hey, AI from Eagle, Idaho. We have a person next week who's going to be speaking specifically about real estate investing in Idaho. So look forward to that. All right. I'm going to introduce Aram and Jeff. As you guys know, these two are one of our club fund sponsors. And last time they spoke with us, we actually didn't put any investment into them as a club. People were warming up to the idea of their particular business strategy. And as we're presenting more and different strategies, I do feel that a lot of this group takes time to understand and to really grok, what's the investment strategy. And I should probably set it as an expectation that the first time you come in and speak, we're probably not going to invest with you, even if I've vetted it and think it's okay. We have to have time to let all the people in the alternative investing club get used to it too. So Aram and Jeff are back, and they're going to give us an update. And what I told them to do was make us jealous that we didn't invest the first time around. but give us an update about what has happened. And since you were in, and that was what, November last year, I think something like that.
That's about right. Yeah, November, December last year, end of last year.
Sure. Okay. So I'm going to kick it off to you guys, and I'm going to go see if I can fix any of the issues with the time zone and events starting at the wrong time and not letting people in.
Okay, that sounds good.
So I'll be back.
So, all right. Well, thank you, Daniel, for again having us again. We're happy to be here. And as Daniel said, look, we've made really good traction since the last time we spoke. Lots of moving parts, although maybe some of you in the alternative investing club didn't invest. A lot of other investors have. And so we're moving and grooving and doing projects. And so we'll share those updates with you. I am going to go through kind of the deck. It's a different version of the deck that highlights kind of where we are. But also I do want to level set and kind of go through the fund a little bit. I'll move through that pretty quickly because I want to leave time at the end for questions. And let's get into it. So this is our LCP Austin Development Fund. It is for accredited investors only. I'm not going to read all of this stuff, but do your diligence. These are done through PPMs, and really, if you come through Daniel's fund, it's done through his fund technically. So, but it's an accredited investor only fund. So let's just talk really quick about modular construction. For those
hey, Aram, before you continue, Daniel, I'm not seeing Aram's slides. Do you need to switch back over?
Not seeing slides?
Okay. Good. Looks good.
Apologies for that. Yep, they're there now.
Okay, great. So accredited investors only. So just real quick, so key trends, right, on modular construction for those of you that aren't aware of it. We think this is going to revolutionize the way homes and a bunch of structures are built, but we're seeing a lot of this in more urban areas or more densely populated areas for sure, or just infill lots like what we're doing. The key thing here is you can build fast. 4 to 6 months you can put a house together, and beautiful homes, as you'll see. And then the cost efficiency. So one, it just reduces the cost because it's factory built and there's savings on material and labor. And I'll show you some of that as we get into it. But these are mega trends that are really driving, and I think will continue to drive what we see in the use of modular construction. So at a quick executive summary page, this is kind of what's going on in the fund. So the opportunity is this. In Austin, they have changed the zoning at some point last year, February of last year, which allows you to now build 3 homes per lot, which is really a game changer because, imagine you could take an infill lot that's empty or that has an old house on it, scrape it, and put 3 homes in. So it radically changes the economics. And we're using, in this case, prefab modular construction, which is a further kind of accelerant. This is a plan that we've been, our developing partner has been using for a few years now, but we can build the houses fast. We can do it more inexpensively. And again, as I said, we've been doing this for 3 years in Austin, so we know the landscape well. We know the process well, and we've been ready to hit the ground running, and we have been hitting the ground running, as you'll see. As far as investor returns in the fund, we have 3 different levels. There's kind of the A1 through A3, the A3 being the 50K level, 100K level, and $1 million level at the A1. And you can see those preferred returns. You get a bump in those preferred returns that, for example, at the A1 level would take you to a 22% total return. Those investments we extended this slightly through March 31st of this year. That's just a couple weeks out to get those extra bump and bonuses. So if you are serious about joining, no pressure, but hey, I'd urge you to really look at this quickly and take advantage of that extra level of return if you're looking for that. And there's only a short 12-month lockup in this deal, so you can park cash here, not forever. It's not something we're going to keep you in for a long period of time. It's just a great place to put money. I've got money in the deal, so does Jeff, because it's a great place. It's given what's going on in the stock market, this is a great place to be right now. All right, let's dig into it. These are who we are. That's when I put on a tie, what I might look like in the middle there.
Oh, I was going to say, Aram, could you slow down a little bit? I don't know if it's just me, but you're talking really quickly.
Sure. I was trying to move pretty quick through this so we had enough time.
I understand.
But yeah, I can linger on this slide a bit. So, the opportunity is we're building 3 homes per lot in Austin. We're using a prefabricated modular model to do that. We've got experience in that. David's in particular has been doing this 3 years. So we've got a lot of background and we know how the mechanics of the city work. And then basically this is set up as a pref deal. So we're rewarding investors with a very, very high preferred return. There's no fund level fees or anything like that. Investors are in the first position to take advantage of these homes we built and the sale proceeds. And it's a short 12-month lockup, so you don't have to stay in it forever if you don't want to. There's a bonus return for those that get in early that we've extended through March 31st. So if you're serious about it and you want to learn more, this is the time to do it. And we'd really emphasize joining as soon as possible to take advantage of that.
Hey, so one question I have before you go to the sponsor team. No, you don't have to. You can go to the sponsor team slide. And you might be coming to this, but I understand right now that Texas is an area in the country that is where housing is doing well. It's not the case in all places in the country. Has there been any significant changes in the market there since the last time you spoke?
No, there haven't. I think the last time we spoke, what we saw was Austin had a big run up in prices in 22. And ridiculous, unsustainable.
We ran up 80% or something.
Yeah, it came back.
You expect to see a pullback at some point when you see big run-ups like that.
It did. It pulled back a little bit and it's consolidated, but within a range, so in a healthy range. So the market does look quite healthy.
Okay.
Yeah, it's settled into a range, and we probably see as things kind of get even more consolidated in the market, we probably see it sort of gradually going up from here. So the offers we're starting to see and the comps we're still seeing are within our spec, right, of what we plan to build to. So we feel like we're in pretty good shape.
And just to mention that is one of the things I did like about your opportunities. You had headroom there in case, but you might be talking about that.
Yeah, we do have a lot of headroom, and again, the investors are going to get paid first. So, right, so we're on the back end.
Yeah.
All right. Well, I won't interrupt.
No problem.
Unless they ask me to in the chat.
Yeah, no, I want to be sure we get to everything. But David is, this is the 3 of us. Jeff and I constitute LaCreme Partners. So maybe I'll talk about us real quick. So we've been at this a long time. as investors, as deal syndicators. Frankly, we find that our differentiated knife edges in finding differentiated things, right? So we've made money in our lives by finding businesses and running businesses and finding opportunities for investors has been no different than that, where we find some differentiated edge. And so I'll show you a couple quick examples after we get off this slide, but this is one of those. And David, one of the reasons we like him as a partner, he in his own right has been a very successful guy running mortgage companies that he still owns some, brokerage companies. He's got a lot of experience both as an investor and a developer. He's done a lot of fix and flips. He's been building these modular homes in Austin. He's done strip malls with anchor tenants. He's done all sorts of really creative stuff in his life. But he has another good knack for finding value and finding opportunities and finding differentiated value. And we've been friends for some time. Jeff's known him for a decade plus. And it was really when this all came together in the last year or so of us talking that we thought this makes a lot of sense. We should prop up the fund to support this activity. And so we've been thrilled with the results. These are a couple slides just showing what Jeff and I have done. We're no strangers to development. This is one of our Buckshot Landing community in Magnolia. It's just outside of the Woodlands, actually, in the Houston area. It was a 129 unit development. We did it from the ground up with a different developer partner. We're in lease up. We're about 75% lease up. We're actually moving toward a sale right now as we speak. And, a lot of challenges. We built this through COVID, but we came out, again, we underwrite conservatively. We give ourselves headroom. We give ourselves margin. So we know we can survive and weather kind of any storm. And COVID was the ultimate storm if you were a builder. And we experienced it. And we still will come out of this giving our investors, we believe, a very, very healthy return. In fact, likely meeting or exceeding pro forma, we feel. And that's coming up real soon. Another one that we did, again, in the build to rent space was just down the road from that, about 12 miles down the street. This is about a year and a half behind the other one. This one didn't suffer as many of the situations that we had with the COVID problems. But again, a couple beautiful communities that we did from the absolute ground up. And, this was all about finding a differentiated edge, and build to rent at the time it's getting a little crowded, that space, frankly. We're having a tough time making deals pencil there. But, again, we're always looking for things that line up with kind of mega trends and how we can offer differentiated, valuable opportunities to our investors. So the fund strategy. So we're buying, building, and selling these homes. We're not holding these. These are designed to be sold. We're taking advantage of this new zoning in Austin. So we're acquiring either lots where there's an older home on it that we just would tear down, or an empty lot, or maybe some home on it with an adjacent lot next to it. Ideally, we try to find stuff where there might be a couple of lots together. So maybe we could tear down and do what we need to do on maybe 2 lots and build 6 homes, or 4, or the most recent acquisition, 4 lots where we'll build 12 homes. So we get some operational efficiency there. But if it's the right deal and it makes sense, we'll do it. We're doing this in fairly established neighborhoods in Austin. We're not way out. For those of you that are familiar with this MSA, there's Round Rock, there's Leander, there's Georgetown, there's these farther flung areas. We're not out there competing with the density of like a DR Horton or something like that. We're really in these infill lots in the city center, more or less, where there is more, I would say, stability on the home pricing, and where the comps are better known, and where we're not going to run into like the absorption problem. If we bring a few houses to market, it's not like you're competing with a 200 house development that's down the street. So we have more, visibility, frankly, on how these houses are going to do once we bring them to market. As far as the proven aspect of this is a plan that David has been doing for 3 years. He was doing it back before the zoning happened, where he was just tearing down old houses or taking a lot and building something nice and new.
And that was on just to clarify, Aram, that was on the AB zoning, which was a house and then an ADU that was 1,100 square feet or less at that time.
Yeah, that's right. So there's a good track record there. He's got 25 million of track record and some ongoing stuff kind of in the pipeline. It's probably grown to more, probably over 35 now as we speak. And as far as workers, he's started with actually a couple of different general contractors locally. So trained up, I think, 3 separate general contractor crews that he could engage and train up to be able to install or put together these modular prefabricated homes. Since then, he's actually brought a lot of those trades in-house to even further speed up and get more cost efficiency in the model. So, again, we just continue to learn along the way, but even from the beginning, it's been going quite well. And then in the end, these are beautiful homes. So one of the things that, I had to personally get over, and I think Jeff as well a little bit, you always hear prefab modular and you think, mobile home park or, it's just sort of not, it's not always been associated with beauty. It's been associated with a more utilitarian kind of thing. But these are really gorgeous homes, high ceilings, modern design sensibilities, finishes that are, very contemporary and beautifully put together. You wouldn't know it. So people ask us all the time, what do you call these when they're done? When you're marketing them, we call them homes, right? You don't call them any different. There's no disclosures. They insure like a home. They sell like a home. They live like a home. There's nothing about these that's goofy.
And Aram, let me make one comment here just to reiterate your point. In fact, these are covered under the same part of the building code as any other home, whereas a manufactured home, a trailer, for example, is a different part of that code. So these are the same exact part of the building code.
Yeah, exactly. So, cost advantage. So how does that really work, right? So one way it works is we have a reduced labor cost. And that is because you're doing these in a factory. You're building these in a factory-like setting. And there's massive efficiencies when you do that. For any of you that have walked by a construction site, they're not the most efficiently run locations, right? There's people standing around, there's garbage, all this stuff. This is a factory-like setting. You've got specs, you've got a kind of a almost conveyor belt-like design to them. So you can be efficient about how you do this stuff, and you can put those factories in areas where the labor can be concentrated, where the labor cost may be lower, and then ship those things to where you need them dropped. You get material efficiency. You can imagine if you're building in a factory and to very specific specs, you've got the ability to not lose a piece of lumber at the side, all these sort of things. It's much more efficient. You minimize weather impact. We build this in an indoor factory. So you don't hear, you always hear about delays, and we've experienced them at a construction site where, it was a week of rain, couldn't do anything. When these things come out, it's a covered unit, the cabinets and all that stuff's already in place. So you're landing these things finished and sealed up effectively. So you minimize that weather impact. And the last is this idea of, it's this duality of flexibility and standardization simultaneously. So we have the standardization of these modules. Think of it like Legos. So I take these 3 Lego blocks, but I put them together and I've got my house. That's one way to think about it. So there's this standardization like you have with a box of Legos, but then there's this design flexibility where, I can configure those Legos to make all sorts of different things, and the look and feel of inside those Legos, I can change out the tile, change out the flooring, change out the light fixtures, all the things to give the finish and the feel that's going to be maybe right priced for that neighborhood. So you get all those great design elements and flexibility, but still having this Lego block kind of fundamental model that gives you standardization that you can work from. The other thing that's nice about that standardization, it allows us to get these engineering drawings for these modules are stamped at the state level. And that means that when we go for permitting, the permitting is very straightforward. One, Austin wants this because they said we want 3 houses a lot, but then they stamp it quickly because all we're approving is like the setbacks and the lot coverage and that kind of thing. We're not approving anything. There's no approval needed, I should say, for the engineering itself, because it's already been stamped at the state level that says, yep, this is what you're building in that factory is good to go. And then, we talk about faster time, but here's how that really shows up. If you look at the top on the traditional, site built there, stick built, I should say, traditional on site. And by the way, can you guys still hear me okay?
Yes, we can hear you fine.
Okay, thanks. So you purchase the property, and then you go into this, design and planning, and that's kind of a little bit of a black hole depending on the area you're in. It can take a long time, it can take a short time, all the permitting, all that stuff. So 5 months is not atypical for a build like this. Then you've got your foundations a couple of months, you've got the on-site construction 8 months, and then a couple months for the stuff that always happens when you're developing this way. In the prefab modular, from the time you purchase the property, you're basically off to the races, because you've essentially short-circuited most, if not all, of that permitting process. So then while the foundations are getting put in place, you've got the on-site manufacturing that can happen in parallel in the factory. So, okay, here's what we're going to need and when we're going to need it. And then you do the foundations, you can parallel path those. And then you drop these, and we'll show you a video in a second with that on-site installation. And that time is significantly less because you're not building from scratch, right? You're delivering these finished Lego blocks, and you're basically just stitching them together, and you're done. So the timeline in an absolute sense is compressed by a lot. And then that time that converts, one, we can build these cheaper, but we can also get a pickup on price or a discount on price because of the carrying cost. So one of the things that anybody that's done development knows is that your carrying cost is a big factor. So you've got money that you've got construction loans, you bought the land for cash or leverage. So all of these things become carrying cost factors that go into the model. Well, we push that down and compress that a lot too. So it's an additional measure of savings for us. And then the modular supply chain, of course, well, you're not building it at the site, but you got to build it somewhere. So you got to be sure that you've got that really well-oiled machine in place. And we have that in this strategic partnership with a well-established company called BuiltWise. They've been doing this 40 years or so. They've got a couple of sites that started originally in South Carolina. The new factories in Roswell that we're able to ship from. It reduces the shipping time a little bit, also gives us just multiple sources for supply. We don't think supply is an issue at all. David and team constantly out there kind of tooling what they're doing, and in the ongoing discussions with them on further ways we could even reduce time and cost. So it's going really, really well. And just to show you guys that this is kind of what those factories look like. You can see how these modules just get built. So all of the lumber, everything's there. And at the end of the day, it is stick built. This isn't like something we've built out of some weird exotic material or out of foam or something where, gosh, we're not sure about the engineering. This is tried and true stick built. It's just done in a factory setting and then delivered kind of as a finished piece that can then be just.
Hey, Aram.
Site. Yep.
We've had a few questions. I've been in the comment section here trying to answer. So yeah, just to really reiterate what Aram is showing you now, this is the factory. It looks like stick built, but in a factory. So it uses very similar techniques, but you might think of it as maybe a more robust version, right? Since these will be, finished up and transported. So it's maybe a more robust version of stick built, but that stick built happens as Aram said, instead of on site it happens in the factory. And then also, yes, the replacement parts and those finishes are the same, right? Whatever finishes we happen to choose, whatever solid surface counters or whatever fixtures or faucets or switches, they're not special, right? I mean, they're things that are available for any homes. And the finishes on these houses really are defined based, as Aram said, based on the neighborhood, right? If we're in a little more expensive neighborhood, we might go with a little better finishes. But frankly, I think the finishes, even in any neighborhood, right, are quite nice. In fact, much better than probably we have in most of our homes in the Bay Area.
Yeah, I mean, the cool thing is, I think modern building, right, does a lot more with space than they maybe used to do in the 60s, 70s, 80s, 90s even. So everybody's figured out, how to build vertically, how to make the use of vertical space, how to create large windows for light and all this stuff. And we'll show you guys some of these units. I mean, they're quite nice and incredibly livable and just beautiful. There's just really nice quality product.
Hey, Aram, could I highlight a couple of questions also?
Of course.
Yeah, James Wong is asking, are insurance rates the same as regular homes?
Great question. They are. This is a home. There's nothing about it that's different. In fact, they're built to the most modern of codes. So if there was an older home that for some reason was built a little more ramshackle back in the day, it might suffer from issues that this new construction would not. So yeah, great question. It ensures it's a home. There's not even a disclosure that says, hey, I'm insuring a modular home. You're insuring a home. You're selling a home.
I usually don't inject my own questions in the chat, but I wanted to throw this one in here. The group here is usually throwing so many questions out that I can't keep up. But I wanted to ask, what percentage of homes are actually built this way, and why do you think this isn't a dominant way of doing it? It seems like there are inbuilt efficiencies in the timeline, in the cost. Why isn't everybody doing this?
Well, it's a great question. The short answer is I don't know. I would be, I would be thinking way too much of myself to say I speak for the entire construction industry or anything like that. I do know that it's historically kind of an industry that's slow to move, right? Yeah. I kind of cut my teeth in tech. So did Jeff. So did many of you. If you were at Intel, and that you innovate quickly. I don't know that construction, frankly, the mortgage industry, just housing in general, the fact that we still have title companies is bizarre to me. Like, that should all be electronic. There's no reason for it. So, there's a lot of things.
I have talked to people inside Fannie Mae that say they're working on innovating in that area.
Yeah. So
we'll see.
I think they are, but it's pretty safe to say those things move at like glacial speed. And I think that I do believe, and I think maybe I said this at the beginning, this is a trend and a mega trend that is probably here to stay. And I think what will also get introduced in this is new construction materials. Now, at this point, we're not seeing a lot of that because I think the cities and municipalities and engineering folks will be slow to respond to that. So, we don't want to be like the super early adopter, because then you wind up getting punished a little bit. But this is tried and true stuff that we can do and land, and it works. I think more people will over time take more advantage of this. And I think they should. I think we have a housing problem in this country. It's a way to build more houses over time. I will say that I don't think.
I also wanted to ask, and this is probably besides the point, but I was curious. The industrial sector is doing really well right now. Who actually owns the building that these are all built in?
David actually has an interest in a piece of this building as well, and I think they crafted a special deal with the city of Roswell. Really wanted this. This was like an old airplane hangar or part of an old abandoned Air Force airport or something like that. I forgot what exactly the story was, but it was this unused building that they were trying to repurpose, and they came in and kind of made a sweetheart deal to get it, and it's driving jobs, and they like it.
Very good.
Yeah.
All right. One last question from Brooke. Brooke is asking, and Jeff, you might have answered this already. I'm not sure, but this is again, I guess, going to the assumption that these aren't standard houses. But his question is, I assume there are no drywalls. How well and insulated and efficient are these homes?
Yeah, so I did answer this one in the comments there. And look, again, you look at these pictures and it clearly looks like stick-built homes. We're not showing you the finishes now, but there are drywalls and fixtures as you would see in any other homes, and switches and insulation. And in fact, in many cases, some of that process is done even that much better, as Aram alluded to, because you can do it very well in the factory. Everything can be, pre-measured and cut properly. And so in that sense, a lot of times it ends up maybe being better or more consistent than you see in the field, but it's a home. It is a home.
Is it fair to say that the home is precisely the same, just like innovators, and I won't compare you, I guess, to people who created an assembly line, but this is an innovation in not what the final product is, but in the assembly process of that product. Are there any differences at all in the final product that are notable or come out to the end user or end buyer?
That's a great point. I think I would say no, is the blanket answer, which is why they insure and they're called homes and all the rest of it. I think you hit it on the head. What you've done in this particular instance is like you have changed the process of building, not what you're building. So you would do the same thing. You would frame, you would do framing, but you would do framing only after the foundation was poured, and you would do it only after, so you have to wait. Then you would bring all the lumber to the site and drop it off in a pile, and guys would show up late and grab a couple pieces. And, in other words, in this case, you're doing it in a more controlled environment. The foundation is happening simultaneously. So you're changing the process, but you're not changing. There's nothing about the 2x4 that's inherently different, right? Now, to your point, I think over time, we will see new building materials, other innovations that may fundamentally change the space. I mean, I'm seeing things like 3D printed houses and things. So there's some things that are very nascent and will develop over time. But for now, all we're really doing is changing the methodology, not the material set per se.
Okay, and I didn't realize that my question there was basically stating Fang's question, because I hadn't read it yet. But she was asking the same thing. Who are the buyers for this type of house? How is it different than normal home buyers? And I think you covered that.
It just isn't. They are normal home buyers. In fact, what they see is what's different about it. It's a new house, and people love new houses. That's the other thing, right?
So here's another question coming to that. But this is definitely worth making sure that it's stated. Do these homes appreciate like regular homes? Or is there special disclosures or other things that could?
There's no disclosure. We don't have to say this was a modular factory built home, right? It's like saying, where did you source the lumber from? None of that's disclosed ever. It's a home, and there's no different disclosures. Okay. I can't say, we haven't been doing it long.
Again, let me just reiterate this one part. It's the same part of the building code, so it's not distinguished differently in that sense.
Okay. Yeah. And it will rise and fall with the market. It's a house. It's going to live in the market and be no different than any other home, other than it's a new home. It comes with a warranty. It's got all the rest of the stuff. So these are new homes. You guys will see, I think, once we get to that
Chris, you made me laugh here. You made me laugh, Chris.
Me too. That was a good one. So Chris actually on his own came to the conclusion that he gets the feeling these are regular houses.
Yeah, I may have said that a couple of times.
It's just true.
They are regular houses.
By the way, go ahead, Daniel.
I was just going to say that is one of the reasons why this interests me, because it's not, there are certain. This is an innovation in how the home is manufactured. It's a business process where the timeline's reduced and the cost is reduced.
Right.
And that's what makes it interesting to me.
But they're beautiful homes. They're thoughtful floor plans. There's good use of light. It's all new and high quality finishes. And I'll tell you, I periodically do walkthrough videos. In fact, I think we'll share.
Yeah, you know what? Let's keep moving, guys. In the interest of time, I hate to do this.
When I visit these and walk through, I compare it to my crappy $1.5 million house in the Bay Area, and I'm like, oh my gosh, I want to live in this house.
Yeah,
much more than my house in the Bay Area.
Yeah. Okay, so I'm going to keep moving, guys, because I want to get to some pictures you can see. But a couple things about just, Austin and the housing market macro generally. So single family has remained pretty resilient. And even when interest rates went up and all this stuff, you've seen a lot of price support, right, for single family homes. There's a few reasons for that. People have low locked-in mortgage rates. They're not selling. Builders have been not supplying homes really quite fast enough. And part of that is the cost of building. Part of that is just not knowing exactly what the market's going to have in store. So there's just a lot of reasons. And we've underbuilt for years, since 2008. So there's a huge gap in the market, and nothing's going to shore it up quickly. And we're building in a market that we think is strong, as evidenced by Austin. So Austin, again, number one fastest potential growing market as forecasted through 2028. The metro area, a lot of job diversity there. So we feel like, just generally speaking, there's good tailwinds in the market. And jobs. So it's population, but it's also jobs and as far as desirability. So job growth, payrolls rose a ton. It's a heavily diversified job market. That matters also. It's not just a one-trick pony town. And as far as best cities to live, it's pretty darn nice. You see it as second on the list. For those of you that have been there or might live there, it's a great town. There's a lot to do. and there will continue to be kind of that magnet for people, including those like some of us out in California that are heading that way. So again, it's the right product in the right market. And then of course the zoning really helps a lot. So let's show you some of kind of what we've done here. This is a short video. I'm just going to hit play here that shows you the modular build process. So this is a crane these things are craned into place. And just like Lego blocks, this was an older one that was done on a pier kind of foundation. We now have full foundations with kind of crawl spaces and things in most of the units. This is also the AB style that Jeff was talking about before they did 3. So you see kind of more like an ADU style in one of them.
So these were some of the proof of concept builds.
But lots of light, high ceilings. We were walking through these, and one of the guys that was one of our investors went, "Wow, this door is like really heavy and solid." He said, "Yeah, what were you expecting?" Right?
You probably move on there. This is just going into the ADU.
Yeah. All right, so that's the other unit. And then here's another one. This is one of our Texas tall boys and one of the latest developments. And this is Jeff giving a tour of this one.
So I'm just kind of walking through with my phone here.
Nice light here.
And this was just within the last month. So this one's, nearly finished. There's somebody working in the house. You'll see here, just finishing it up.
These dark accent walls.
Really love that beautiful accent wall there.
So again, this is 1600, more than 1600 3.2. You got some light right
3,
here.
2.5. You have to listen to me ramble on there.
For here's a downstairs bathroom. I love that this accent wall.
Yeah, I love the accent wall kind of carried into the bathroom there.
But doing a lot with a fairly small space there.
And we'll head upstairs.
It's a back bedroom here. This is a bathroom on the second floor here. So I guess this is going to be a 3.3, I think, in this model, maybe. Okay.
That's Jeff. Yeah.
There's the front bedroom. Ceiling fan, closet. Good light. Windows all the way around. I'm shooting a video. There's Paul doing a little work here. Thank you. So this is the master here. All right. Sorry, Paul. I'll get out of your way here in a sec here. All right. Got a his and hers. Walk in.
So nice big bathrooms.
Bathroom. More windows.
Sorry if I'm making you seasick here.
Right. Let's see here. We've got a deck out here. All right. There you have it.
Yep. So yeah, so you guys can kind of see, it's beautiful stuff. We have a new sales office also, which is near one of the larger lots. There's actually 12 lots on this parcel, and a couple of those are in our fund. And so there was a sales office. Steve's kind of propped up a sales office there so we can show off these various models and get people excited about things. And it's proving to be really good. We've got a lot of traffic. People are coming in. They're talking, agents, buyers, a lot of excitement around this. And
they might come in for one location and then see the other locations we have as well. So
yeah, so it's working out really nicely. And then they all could also in that sales office kind of experience, the kitchen and the finishings and all of that kind of real time. So they can come in and, just touch and feel stuff, which makes, all the difference, right? It's not just, you're not just looking at a rendering. This is real stuff. So this is helping to drive a lot of activity. We've got some things in negotiation, and even before they're totally finished. And, those are coming in at our expectations on price. So just say like, where's the market? We feel pretty good about, where the market is and where our price point is. So I can move a little bit into kind of the financials and the fund terms and kind of how we put all this together. So, but I'll take a quick pause. Were there any questions in there that were coming up?
Yeah, there's a couple of them.
Okay.
I want to jump to Prolette's question here. She is saying, housing markets have been quite slow in the last couple of quarters. It is picking up a bit, but there's a lot of supply. Can you talk a little bit more about how you deal with those challenges?
Yeah, I think, it's interesting. I think there's the headlines of the housing market and then what's happening at any given, location, right? And even it gets down to streets at some point. So, we have guard banded our underwriting to account for some of that. Like I said, we are seeing offers. It's too early for us to say that, yeah, we've got, this is our average sale time because we just don't have that much sales history yet. But I will tell you that we're very pleasantly surprised by how many, offers are coming in and contracts are in negotiation before houses are even finished in cases. So that's great. That tells us we shouldn't have too much of a problem getting the price point we want. But we've also underwritten, these for longer time than we need to account for any, 100 days or something that it might need to sit on the market. So I think, we've got enough cushion there in just the financial model, but I think we're bringing a really nice, unique product to market. I would feel a lot less comfortable if we were putting if we were building 100 homes in one neighborhood, phase one of some big development, and I've got to figure out how we're going to move these quickly. That's a little harder. The other thing is that, sorry, go ahead.
Yeah, could I just throw out a couple of stats that I looked up? This is from Rocket.com, which is one of the larger mortgage lenders. But Austin apparently has had an increase in home transactions, single-family home transactions, of 9.4% year over year. And they're currently sitting at around 5.6 months worth of inventory, which is up from where it was, but it's still way below what normal inventory is.
So Austin's a pretty expensive market as well. So we're meeting on this weekly, and we're looking at days on market at all of the different price points. I think a lot of the homes that we're building are sitting. So they're still relatively expensive, right? Just because Austin is an expensive market. But there are the higher end of Austin market. You'll definitely longer days on market, right? We're trying to be below that so that we can transact these, much quicker. And then Austin does have a very large sales volume, right? It's a big enough market where there is a lot of transaction.
Yeah, so I think when we think about it, in fact, this next slide in the capital, in the financial section, when we think we're really building in this, we're building in the city proper, right? We're not building in these other, far-flung areas of the MSA. So there is, good price support in those markets. They're highly desirable neighborhoods. They're also established neighborhoods, right? So there's high demand, and we're coming in at home prices in the $600 to $900 range nominally. That tall boy that Jeff was walking through, we have that in a neighborhood where the range of home prices will be they'll average out at about 660 is kind of what we're targeting. So it's a beautiful house for $660,000, right? And it's highly competitive for what you're getting in Austin these days. So we feel pretty good about where we're pricing things. And we have some price cushion in the model, actually a lot of price cushion in the model, as we'll show you, that gives us a lot of confidence. And at the end of the day, the way we've modeled the fund is the people that frankly do worse if there's a slight depression in those sales prices is us, because the investors are in that kind of prime position to get their prefs, well before any dime is taken from Jeff or I. So
just to let you know, we have about 10 minutes left.
Yeah, let's move quickly then. All right.
Hey, I want to make one comment, though. I think an important one while you're teeing this up. So I've seen a number of comments here. Just to be absolutely clear, these are not mobile homes and they're not manufactured homes. So those would be like if you're in a mobile home park or a trailer or things like that. And there's some, Clayton, for example, is doing these, and some are nice and some are not nice. But this is absolutely not those. So it's not manufactured homes, not mobile homes. These are homes covered under the same part of the building code. They just happen to be built in the factory and installed on site rather than being built on site.
Yeah, exactly right. So let me show you an example of the financials of a project that lives inside the fund. So just to be clear, the way this fund works, there's the fund, and then the fund, as investors, you would invest in the fund. The fund then not loans, but essentially funds, is the sole funder of each one of these projects. Each project is kind of its own entity and has debt at the entity level. So we might say this project in this case, this project needed $705,000. The fund gives $705,000 to that project entity to do the work. That then leverage is put on that to build all of the homes and do what we need to do. And that leverage, David is the personal guarantor on those loans. So he's definitely got, he's got that high level of commitment. And then when we sell the homes, the profits from there, less a 1% developer fee. That's the only thing. And our lawyer said you got to pay him something, otherwise it looks bad. So we have a 1% developer fee, certainly not the reason he's doing it. Then the rest of the profits come back to the fund from each one of these projects, and then the fund pays investors, and then whatever profits are left over, we as the sponsor team, split, right? And most of that, in fact, goes to David because he's doing the lion's share of the lifting here. So as we look at that, you as an investor in the fund, you're not invested in just one project. You're kind of diversified among all these projects. So even if one does not as well as the next, or one, you are still in the first position in the aggregate returns of all of these, proceeds to lay claim to that pref. So it's all these ways. We always think about ways of de-risking elements for investors because we're investors ourselves. That's how we started our career, right? In this, before we ever did deals ourselves, we're heavy investors as LPs, so we know what that experience is like. Okay, so in this case, let me walk through what one of the project economics look like to give you a sense of why we think we can pay these high prefs and be okay. On the left-hand box shows you what we're doing. So there were 2 lots, 3 houses per lot, 6 total houses, each of them 1,664 square feet. These are those tall boys that Jeff walked you through. That's the size of them, give or take, right? So square footage, about 10,000 square feet. So now we're in the middle column. In the middle column, you see the land, this kind of sources and uses. So the land cost for the 2 lots was $670. We had some closing costs of $20K. And then our construction cost all in, that's the most expensive piece, right? This is the modules and everything. It's just over, nearly 2.1 million. So the total land and construction is 2.7, nearly 2.8 million. Now, the financing I spoke of, this is the loan that's sort of living right there at the, on that particular project. Construction financing isn't cheap. So, 11.5% nominally is pretty fair. It's a short-lived loan. So the loan amount then, the leverage we use is about 85% typically. So that means we have a loan of 2.36, right? 2.369, 2.37 million. There's fees, right? The one-time loan fees, and then the interest. So the carrying cost, right, is $179,000. That's for 240 days, which is close to 9 months. And, that's probably on the outside what we would need. We probably need shorter than that, much shorter than that. We showed you, 4 to 6 months, you can land a house. So this gives us plenty of headroom. Now, the thing also, as you meant, there was a question about what happens if these things sit for a while. Well, you can see in 9 months, if you've got 180K, that really tells you that you've got a carrying cost of about $20,000 a month on 9 homes. So, I'm sorry, on 6 homes. So that's like, $3,000 a house or something. It's not a big deal. So yeah, it'll eat into your profits a little bit, but if it takes a little longer, it's actually not the end of the world, even with a high interest rate, because it's just not that big of a carrying cost. So, other factors, you've got property tax, insurance, and utilities that you're paying during that time. So those are factored in. So we got a total build cost of just over 3 million, right? 3,075,000. And so the equity needed would be the combination of, those carrying cost numbers plus that 15%, kind of down number, right, that you would need. So you put all that together, and that's kind of where you wind up, again, with the loan being, with the land being part of that. So so $705K is what you wind up needing to fund the deal. So essentially what that means is the fund writes a check basically and says, okay, yep, we like the project. And the way it works, Jeff and I are the managers of the fund. David is not the manager of the fund. So we have a separation of powers essentially. So we can look at that deal and say, yep, that makes a lot of sense. Let's do it. And we go forward. And then then David does the thing. And we've actually turned away a few deals that just we didn't think were quite right for the fund. Then we do all of our stuff. Then the project return is off to the final box to the right-hand side. Price of the units about $660 each. So that would give us a total revenue of just under $4 million. There's the cost of sale, realtors and all the rest of it. So the net sale proceeds is what's left after you pay back the loan, and all of it was this 1.3. So that says there's an equity multiple line too. So in 9 months, you've put in $705K, you get back 1.352. That's a healthy clip. And that gives us more than enough money to pay investors. Even if things go a little sideways, take a little longer, we feel like there's plenty of room here to make the pref promises that we are making. So that gives you a sense of the economics. The fund itself, the basic terms, again, this is kind of the classes A1 through A3, the amount, so minimum is $50K. Now this is at the fund level. I'm going to turn you on to Daniel, of course, who can you can go through the alternative investment club fund also to invest in this, and so you can speak to Daniel about that. But this just gives you a sense of the tiers and what those prefs are. Everybody's, the people that came in, and just to tell you, like those people that came in last year, they're making their 17, 18, 19%, they're making their percentages, and we're going to start paying them soon. So if you think that's a good rate of return, as I do, because I'm an investor too, I would encourage you guys to get into it. Now, as far as fee schedules, as I said, there's no asset management fee, no acquisition disposition fee, the developer fee, that's that 1% I mentioned that David kind of keeps to be a developer, just so we can show that legal arm's length relationship, frankly. But that's it. We plan to pay after being in a few quarters. We plan to start paying folks, and then you'll get caught up on any pref, and then every quarter you'll get paid from that point forward. That's basically it. I'm going to move to this slide. This is how to invest. This is that QR code. I encourage you guys to all scan that right now. That'll take you to Daniel's Alternative Investing Club Fund page. You can fill in your information. I'm sure he'll reach out to you, talk to you about your options to invest. We're of course available for other questions. Daniel, I'll turn it over to you.
Yeah, I was going to say one thing that I really like about this is that, first of all, there's only a 1-year lock-in period. So and each project itself is for usually less time than that, often significantly less. It's kind of 6 months plus. Yeah. So I've been on the search for projects that have more liquidity and are able for the investors to get a good rate of return going in and being able to come out when they want. A lot of real estate, as you know, locks you up for 4 to 7 years or whatever it is, and that's one thing I like about this. The other thing that I like about this is just the innovation and the go-to-market strategy and the construction strategy that brings the timeline down and means you have less carrying costs, and that means that your costs aren't as much as others. So if the economy did come down, you're in a position where you can still sell at a lower price point and make a profit. And that's honestly the sort of thing that I'm looking for. And it's a unique business strategy. That's the other part that I like the fund. It's unique.
And Daniel, the other thing is, because these are a series of projects, we can always course correct. So if something does start softening up, we might just adjust our buy box to account for that,
or stop.
Right.
We can always. I mean, if you think about our longer term projects that took 4 years, right? We had to weather a lot of storms to get through that, and we had to think about 4 years from now what that's going to look like. This week, our time horizon is very short, so we can pivot, as Jeff said, and at some point, if it dries up or it becomes challenging, that was good. 2-3 years from now, we just whatever it is. We'll make the right fiduciary decision for everybody, and we will have all made our money and say, well, that was a nice chapter, right? Because all things have a season and things change. So we have to be able
Fang
to.
is interested in what the construction loan rate is.
Yeah, I think we talked about that. So it's about, it's anywhere from 10, 12% roughly. We have it penciled at 11.5. It's not atypical. But
apparently this style of manufacturing made bobvila.com. So Ben Lee is showing us that there's an article on what the difference between mobile homes and manufactured homes are.
Oh, excellent.
And you might have to look at that to see if this is exactly what you're doing or not.
Well, so we're not manufactured homes and we're not mobile homes.
Yeah.
But,
yeah. Okay.
Yeah.
Any other questions? Go ahead and put them in the chat. And if not, I would invite everybody here to say thank you in the chat to Aram and Jeff for coming and speaking to the Alternative Investing Club today. I really do miss the ability to take all the attendees off mute and just have them say it.
Yeah, the good old days, man.
That was great. It was great.
Your audience is fantastic. They're very active. So you guys are asked a lot of
There we
great
go.
questions
The thank yous are
and a lot of
coming
great
in.
comments. Thanks.
All right. Well, thank you guys. Thanks very much. And Daniel, thank you for having us again.
Yeah.
And as I said, no urgency, but hey, I'd get in now.
Yeah. And so the Alternative Investing Club Fund, since you are a club fund speaker, we'll be putting out a call for capital, or we'll go to our investors and the people that are here. And you can just go to alternativeinvestingclub.com/fund and sign up there. And I will follow up with you. And I'm going to follow up with a form that says, which, are you wanting to specifically put it into this? I want to give this club the opportunity of having their voice heard within the fund. And so you can earmark either that it's at my discretion, or you can earmark, which of the projects you want to put it in. And of course, we'll highlight, our current speakers for this week. But it's wonderful to see all of you out there today. And it's wonderful to get this sort of interaction on the comments as I'm tongue-tied.
Really appreciate it, guys. Daniel, thank you for having us, and thank you all of you for spending your valuable time with us. Really appreciate it.
Thanks, everyone.
We'll see you all next week, and have a wonderful weekend.
Bye now.
Bye.
Oh, for those who are interested, we're speaking on Idaho next week.
Daniel, would you like us to stick around?